Welcome back, WSU Vancouver VITA volunteers. This lesson continues our series on the advanced topics of the VITA tax law course. So I'm going to remind you that if you haven't been through the basic lessons yet, to go ahead and watch those videos first before entering into these more advanced lessons. In this lesson, we are going to begin discussing business income. So this correlates to the business income lesson in publication 4491. And there's quite a bit of material, so we're actually going to split this lesson into two videos. In this first part, we're going to discuss what business income is. We'll figure out how to recognize when our taxpayers come in needing to report this kind of income. And we'll look a little bit at some of the forms and how they flow in a very high overview, how they flow onto the return. And then we're going to be spending quite a bit of time on scope issues. We do have a lot of scope issues, and we really want to make sure that we are figuring out ahead of time whether we can help this client with their return this year, or if they are in a situation where they need to see a paid preparer. At the outset, let's define what business income is. And business income can be income received from the sale of products or services. Thinking of selling products is probably pretty straightforward in recognizing that as business income. Services, on the other hand, might be a little more tricky. We might run into more questions of whether somebody is an employee or whether they are a self-employed individual. We'll look a little bit more in one of our next slides coming up at that. But some examples of business income might be fees received by a professional. There also could be ride share and certain other delivery services, those kinds of services. And if somebody is in the business of real estate, it could even be rents received by that person. But we want to note that there's a lot of scope issues for VITA. We are probably not going to be doing that return. And then it's really important to recognize as well that any payments that are received in the form of property or services must also be included in income at their fair market value. So this is like bartering. And here again, if we have a taxpayer and we discover that they've been doing some bartering, we have due diligence. We need to tell them that this is something that needs to be reported on their return. But unfortunately for this year, we would not be able to help them with that because bartering is out of scope for the VITA program. And as I had just briefly mentioned, this business income comes from self-employed taxpayers. So these taxpayers might be owners of a sole proprietorship. They might be considered independent contractors, or they might be what's called a statutory employee. And these are a little bit different than somebody who fits your regular classification as an employee. And a lot of it has to do with who has control over what and how the job gets done. And publication 15A is an excellent resource to help determine whether somebody is an employee or an independent contractor. Now, generally speaking, this is not something that our taxpayers need to figure out. It's whoever they are working for classifies them as an independent contractor or an employee. But it is important to note that sometimes businesses incorrectly classify certain individuals, and there's reason to do so or incentive to do so because an employee, the employer has to pay part of the employment taxes, where an independent contractor pays for the full amount, both the employer and the employee portions of that tax. So if we come across somebody who we believe or they're concerned that they are incorrectly classified, we can always kind of get a general idea by looking up the information in that publication 15A, and if it looks like there really may be an issue, they need to get in contact with the IRS, and the IRS will work with their employer to make sure that that person is classified correctly. So we need to know how to recognize these clients that come in as self-employed individuals. And the first place that we're going to look is our intake and interview form, Form 13614C. Under the income section, we have questions 7 and 8. Question 7 is for self-employment income. It lists a few forms. It talks about, other kinds of payment that they might have received, if they received cash or virtual currency or any other property or services. Question 8 asks if they received cash, check, virtual currency payments, or other property or services for any work performed that wasn't reported on a Form W-2 or 1099. And then we also need to be using our interview skills here because a lot of our clients maybe didn't realize that they received some sort of compensation that was not part of being an employee, and that made them a self-employed individual. And they essentially started a business and they didn't realize that. So, some things to look out for might be if our client has some gaps in their employment status, or if they are receiving an income that seems a little too low. We might start asking, are you sure you maybe didn't have any other income? Did you, start driving for Uber or taking deliveries for Postmates? Are there any other handyman kinds of jobs that you're doing? Just kind of double checking, and of course avoiding anything accusatory, but just double checking that we're catching all of that income, because while we understand the tax law and how things need to be treated, only our taxpayer knows what happened during the year. And so we need to be working together to help them be able to report their income in an accurate way. And then along with the income side of being a self-employed individual, there is also an expense side to that. And so question 7 in part 4 for the expenses is about expenses related to self-employment income or any other income received. So these can all be starting points and talking points when we have this discussion and interview with our taxpayers. So let's talk about some of the other forms that our taxpayers might be coming in with. These are forms that were given to them by an outside party. So one of our probably most common forms that we will see is this Form 1099 NEC for non-employee compensation. And you can see here, it's a pretty straightforward form. Box 1 is where that non-employee compensation will be reported, and box 4 is where the income tax is withheld. In TaxSlayer, this is an option that you can choose, a form that you can choose right off of the income menu, and it will take you to an input screen where you can input all of this, and from there you can attach it to a Schedule C, which we'll talk more about Schedule C later. Now, it's important to note that not all taxpayers who have non-employee compensation will necessarily receive this form. Organizations are required to use this form if the self-employed individual was paid more than $600, but if they were paid less than $600, they still need to report that income on their return, but they won't necessarily have this form. Another form that we might see taxpayers come in with is this 1099-K, and this is for payment cards and third-party network transactions. So if they had any payments from a payment card that they received through their self-employed activities, so this is, credit cards and debit cards, they will be coming in with this form. Another way that they might be coming in with this form is through other third-party network transactions, and a good example of this might be our rideshare companies. For individuals who have transactions that exceeded the $20,000 and 200 transactions, then that third-party network which could be a rideshare, it could be somebody else who received those payments and then forwarded the self-employed individual's portion to that person. They will be also issuing this 1099-K to our taxpayers. Another form that we could see from our clients is actually a Form W-2, but in box 13, they would have checked that they were a statutory employee. And a statutory employee is an independent contractor who is considered an employee for tax withholding purposes. So the employer or the company that they're providing services to is going to withhold Social Security and Medicare tax for this individual. But because they are also considered an independent contractor, they may be able to deduct their expenses. This isn't a super common situation, but it's also not an entirely uncommon situation. Individuals that might have this would be like people who sell life insurance. And the last informational form that we are going to look at is the 1099 miscellaneous. And specifically, we're looking at boxes 2 and 3, which is royalties and other income. If somebody is engaged in the business of writing, for instance, or a performance artist, it's possible that they might be receiving royalties from previous performances or works that are associated with their business as an artist or a writer or whatever. And so, in this case, we're looking at boxes 2, 3, and 4 is the federal income tax withheld. A lot of the boxes on this form are out of scope, so if somebody comes in with this form, you're definitely going to want to be looking up in the 4012 to make sure that we are not overreaching our scope. Now, aside from these informational forms, we also need to remember that even if our client did not receive a form, they might still need to be reporting income. And so any income that came in as cash, any income that came in as virtual currency needs to be reported. If it's a virtual currency situation, they are out of scope for us, but we still need to let them know that they have to report that as income. Let's take a really high-level view of how this self-employment income flows through a return. We will be getting into more detail in part 2 of this lesson, which will be in another video. But for now, we're just kind of getting an idea of how things get put together. So in order to report self-employed income, our taxpayer is going to be filing a Schedule C, a profit or loss from a business. And again, we'll be looking in more detail at this form, so we don't necessarily need to delve in right now, but essentially all of the income items are going to be on this form, and then all of the expenses associated with this business also go onto this form, and then the net profit or loss is calculated out, and that's going to flow on to Schedule 1, line 3. And just so that we're thinking about it already, we're going to go a little more into scope issues. If it is a net loss, we will not be able to help the taxpayer with this return this year. For VITA scope, we can only do Schedule Cs if there is a net profit. Here you can see how the information flowed, that net profit or loss flows on to Schedule 1, which is our schedule for additional income and adjustments to income. Comes on to line 3, and then it gets tallied up with any other additional income items that the taxpayer may have, and that total gets put on to line 10, and then that is going to transfer over to the front face of the page of the 1040 form. So that's page 1 and line 8. And here we are on 1040, page 1 and line 8 there, other income from Schedule 1, line 10. And you might notice that this line comes before we get to adjusted gross income, our adjusted gross income line. So while personal deductions are generally taken after the adjusted gross income line, our business deductions are taken before that line. But again, we'll go into more detail about business income and all that calculation and the effects of it in our second lesson. For now, let's turn to our scope issues. So when somebody comes in as a self-employed individual, or we've identified that this is somebody who's going to be filing a Schedule C, we have some green lights, I guess we'll call it, for whether we can do this return. So we're looking at individuals who have less than $35,000 in business expenses. They are going to be using the cash method of accounting. So if somebody is using accrual or a hybrid form of accounting for their business, they're going to need to see a paid preparer, but we can do cash. They need to not have had any inventory at any time during the year. And as we talked about before, they can't be having a net loss from this business. So this is one of those things where it's really handy to look at all the forms of income they had and collect all of their expenses. And before we start entering anything into the return, just doing a quick calculation to see, is this person making a profit, or is this person probably going to be a loss, and in which case their return will be out of scope and we'll need to send them on to a paid preparer. This person cannot have had any employees for their business during the year, and that includes paying for any contract labor services. So if they need to be giving 1099s to somebody for contract labor, that's also out of scope for us. They can't be required to file Form 4562, and that's the form for depreciation and amortization. So any businesses that require depreciation or amortization are out of scope for us. And that also includes any businesses that are wanting to make a 179 expensing election, where they would be expensing items that would normally be depreciated. That particular election is out of scope for us. And then the last one is that they can't be trying to deduct any expenses for the business use of a home. I do want to clarify one issue with regards to expensing items that would normally be depreciated. In our materials, it's sometimes a little bit unclear about what they're talking about. They're talking about that 179 election. There is another route for small businesses to expense items that might otherwise, have a useful life of longer than a year, and you would think, oh, that item maybe needs to be depreciated. There is what's called a de minimis safe harbor election. And this allows our businesses, which are generally pretty small, and depreciation becomes really challenging and expensive for them to track. So if they are using this safe harbor, it's for tangible property, of course. They can elect to expense items of up to $2,500 per invoice or item, and it needs to be substantiated by the invoice. As long as they have an accounting procedure in place where they are consistently expensing these types of items. So they can't be taking some items and depreciating them and other items and expensing them. It needs to be consistent. However, for our small businesses, if they don't have what's called an applicable financial statement, they don't necessarily have to have this policy in writing, but they do need to be behaving consistently in order for it to be considered having that policy. So they would make this election by attaching a statement that's titled Section 1.263A-1F, De Minimis Safe Harbor Election, with their timely filed original federal tax return, and that timely filing includes extensions for the taxable year in which the de minimis amount is paid. So long story short, if somebody is filing a late return and they didn't have an extension, or they've exceeded the extension period, they can't be making this election. But as long as they're timely filing, this is something that they can elect to do. So 179 expensing is out of scope, but the de minimis safe harbor is in scope. And for a lot of our clients who are self-employed individuals or they're independent contractors, they're really going to most likely be naturally using this anyway, so we can just help them, report it correctly so that it's on their tax return correctly. For more information about how to do this, you can look at publication 4491, page 9-10. That's not 9 through 10, that's 9-10. And then also the IRS website has some frequently asked questions pages regarding this election. So, if you just remember that, there's this de minimis safe harbor for items of up to $2,500, and then just go ahead and look it up before you put it on the return to make sure that you're doing it correctly. But it's just cueing you to know that it's there and available for our taxpayers. Now that we've talked about the types of Schedule Cs that we can do, we need to discuss the types of Schedule Cs that we cannot do. And there are a lot of tax situations that are beyond the scope of VITA for Schedule C. We basically do very simple Schedule Cs. So if somebody is engaged in not a business, but actually a hobby, so this is like a not-for-profit activity, that type of income, which can sometimes be confused with Schedule C income that is for profit, if it turns out that it's really not for profit, it's just a hobby and they're making a little money on the side, unfortunately we can't help them with that on their return this year. They need to visit a paid preparer. Bartering income, we talked about that already. If they are getting goods or services in exchange for their services or goods, they will need to see a paid preparer. If they have expenses over $35,000, that's out of scope. Any returns and allowances is an out of scope issue for VITA. As we talked about before, inventory. So if they are having cost of goods sold, we can't help them with cost of goods sold or any inventory. And if they have expenses for employees or contract labor or the business use of a home. Again, this is kind of the flip side of what we talked about, what we can do. A lot of the same issues. But we do have more detail and more situations for Schedule C returns that are out of scope. So continuing on, if this self-employed person in their business had any casualty losses, that would be out of scope. Vehicle expenses that are reported as actual expenses. And in our next lesson, we'll talk a little bit more about vehicle expenses. We can help people with the standard mileage rate if that's what they're taking. But if they're, actually keeping receipts and trying to deduct their actual vehicle expenses, that's going to be out of scope for us. And then, as we discussed before, depreciation or the election to expense business assets, and that's other than that de minimis safe harbor election, or returns and allowances. If they have a rental or lease expenses, if it's for a vehicle lease of more than 30 days, so they're, if they are just leasing a vehicle for, a quick travel trip or something like that, and that's what the expense is for, we can help them. But if it's more than 30 days, we aren't able to help them with that. Any accounting methods other than the cash method, so we talked about that before. Net losses we talked about before. And then if the taxpayer does not meet any of the tests for material participation, or they are uncertain about whether they are materially participating in the business, then that will be out of scope. And material participation is, are they engaged in this business? Are they performing the services? Are they selling the goods? Are they making these business decisions? Then that's considered material participation. A few more out-of-scope Schedule C situations are taxpayers who received any credit card or similar payments that are not includable in income. So remember when we were looking at our scheduled 1099-K, where they would have reported to them any credit card or debit card transactions. If those are includable in income, great, we can help them with that. If those are not includable in income, or some are not, then we would need to refer them to a paid preparer. If they have a yes response indicating that they were required to file Form 1099, that yes response refers to one of the questions on Schedule C, which again we'll look at in a little bit in the next part of this lesson. Basically, again, what we're looking at is, did they hire any contract laborers? And if they did and were required to file this Form 1099, then we would need to refer them to a paid preparer. And that's regardless of whether they already filed the 1099 or whether they still need to file that 1099. And then any income from the manufacture, distribution, or trafficking of a controlled substance. So this is important because in Washington State especially, we do have businesses that sell marijuana, and it's legal within the state, but there are legal issues on a federal level. So for the VITA program, we're staying out of that situation. So that's out of scope for our program. They still need to report that income, but they need to see a paid preparer. And then we kind of briefly touched on taxpayers who received virtual currency or owned any virtual currency or paid any virtual currency. Those returns are out of scope for VITA. Aside from issues that are really straightforward scope issues for VITA, with Schedule C and self-employed income, we do have some extra due diligence to perform. Again, this is something that we do when we are talking with our taxpayers and interviewing them. And as a reminder, if at any point you feel uncomfortable with the information that is provided to you, that something doesn't seem right, it does not seem like this is going to be an accurate return, an accurate reflection of this person's income, you do not need to complete their return. As a first line defense, if you're starting to, ask these questions and you're feeling uncomfortable, you can always ask another preparer or the site coordinator, to maybe have a look at some of this and see if there's, an explanation to how this might work if you're not sure about your knowledge of the tax law, or sometimes it's just a good out to say, let me have my colleague look at this because I really want to make sure that we are providing accurate services, that we are helping you file an accurate return. And between you and the other volunteer or the site coordinator, might be able to more gently tell this person that I think this is a situation where you need to see a paid preparer. So some of these kind of red flag situations, they occur a lot more often when their return is also interacting with the earned income credit, because as you might remember from the basic lessons, the earned income credit is a refundable credit. So somebody can get money back more than what their tax liability had been in the first place. So it can be an area where there are more issues with tax fraud. And Schedule C is one of those places where there's a little more flexibility because we're not necessarily just relying on records that are provided to the individual from an outside source, those informational returns. They might be, relying on their own records. And so there's just a little more room for situations that are not honest to occur. So the situations that we're looking for, that we're going to recognize and say, hey, we need to ask more questions, we need to understand the situation a little better, would be any Schedule C where the income reported is in round numbers. So sometimes, you ask somebody, how much did you earn? And if it sort of appears that they're making it up on the fly, or, it's a number that just doesn't seem to make sense with reality, how often do things occur in round numbers, we might need to dig in and ask, a little bit more about this income. Where did it come from? Where are they keeping the records of this income? Do they have any records of this income, like, a bank statement, those kinds of things. And then a Schedule C for cash businesses, and it's the only source of income on a return that's claiming earned income credit. So they, the only source of income is this Schedule C, this business. They aren't claiming any wages or other things that could qualify them for EIC. And their business is entirely operated in cash, which of course cash is a little harder to trace than other types of income. If they're getting checks or card payments, there's a little more of a paper trail there. So also a Schedule C with little or no expenses when you would expect to see expenses. So, here again, this might be a situation where somebody was trying to hit a certain mark for earned income where, there's that kind of sweet spot between enough earned income but not too much earned income. So if they're manipulating their expenses and their income to try to get that maximum number, that can be a problem. Our Schedule C filers are required to not only report income, but also report their ordinary and necessary expenses, which we'll talk more about ordinary and necessary expenses in our next video. But we really kind of need to see some sort of expenses associated with this income. It's variable with the type of income, but generally there's going to be something. So a Schedule C taxpayer, again, with little or no records for their income or expenses, to be honest, this isn't actually all that uncommon, and it doesn't always mean that somebody's trying to commit fraud. In our next lesson, we'll cover a little bit about how to help our taxpayers. We can help them with some minimal reconstruction. If it's a big reconstruction, then we kind of need to educate them and help them know what to do and say, hey, why don't you make an appointment for later once you've gotten your records a little more together, and you can do this and this and this, and then we'll be ready to help you with your return. But if they don't have any records, or they're, the records are not enough really to substantiate, really we don't want to be helping this person prepare their return right now. We want to say, hey, come back. And then any Schedule C income that qualifies the taxpayer for the maximum amount of earned income credit. So again, like I was talking about before, if it seems like there's some manipulation of the income or the expenses to get that maximum amount, that's a warning sign. And then a Schedule C without a Form 1099, not necessarily that there's anything shady going on with that, but it's something that you might want to, be asking a little bit more about, how this person keeps track of their income, if they're not getting that informational return that's going to help to verify that that income came in. So now that we've been introduced to business income and what it is, and we learned how to recognize our clients that come in with self-employment kinds of income, and they're going to need to file a Schedule C. We looked at some of the forms that they receive, informational forms, and how the information flows onto the return in a very high-level way. And we went through some extensive scope issues and some other situations that aren't necessarily scope issues, but might raise a red flag that we need to do a little more due diligence. Here's what we're going to do. We don't have any questions or practice returns in the midpoint of this lesson. I'm just breaking it up because it's there's just so much information to cover. So go ahead and take a break, and when you're ready, go ahead and watch Business Income Part 2. In Part 2, we are going to cover more detail about what that Schedule C, the parts of the Schedule C look like. We'll be talking about what are the kinds of business expenses that we can help with, and a little bit about record keeping and how to help our clients both learn and possibly reconstruct, if needed, their records so that they can file an accurate return.